Welcome, everyone. Thank you for joining us tonight. Um, Thank you for joining the Center for the Women of New York. The Center for the Women of New York advocates for women's rights and full equality. Since 1987, CWNY has been empowering women to reach their full potential by offering services that provide the skills, information, and support they need to address economic, emotional, and legal challenges. Tonight we have our October Financial Literacy Series workshop, and it will be on consumer credit, good or bad for financial freedom. We have Kathy Carroll, like always, our great guest speaker on our workshops, financial literacy workshops. And I am Cecilia Venusta-Weigel, president of the Center for the Women of New York. I'm very happy to have you tonight. CWNY offers educational programs, support services, and classes. Our educational outreach consists of panel discussions and webinars on domestic violence, trafficking awareness, health and wellness, financial literacy, and independence, such as like this workshop here. We also have our ongoing services, have a caregiver support group for those of us who take care of our aging family members or friends. We have a women in crisis support group, ESL classes, fitness classes, and referrals. So if you don't know if we offer a service, feel free to give us a call. We'll guide you in the right direction. We'll connect you with city agencies and partner organizations. If you would like to watch any of our webinars, you can, of our past webinars, you can find them at cwny.org/past-events. If you'd like to ask questions, please feel free to put them on the chat. They will be addressed at the end of the presentation. You can use the chat on the bottom of your screen. And if you dialed in, please email your questions to events@cwny.org. If you could please help us learn where you are. Just for the purpose of getting funding, we need to let city agencies know where our audience is. So just use the code. You don't need to share anything else. And that will be in the chat. Lana Pelotz is here as our amazing staff member, team member that helps us in the back end. Thank you, Lana. And now, Kathy Carroll, welcome. Please introduce yourself, and the floor is yours. Thank you so much for being here with us.
Thank you, Cecilia. Thank you, Lana. Yeah, it's always a pleasure to be here and to have the monthly webinar. So tonight's topic in the Female Financial Freedom series is going to be consumer credit. Is this good or bad for financial freedom? So thank you all for being here. And I just wanted to say one thing not on the topic before we get started, related to income taxes, of course. And I just wanted to mention that many people would have been on extension for last Friday, for October 15th, for their 2020 tax returns. Well, in case you didn't make that deadline, there's good news, because the IRS has announced that personal taxes and business taxes that were on extension and that were due last Friday are now further extended to January 3rd, 2022, because of the storm Ida, and the IRS had declared New York State, not New York State, New York City, Westchester, and parts of New Jersey to be a FEMA disaster area. So because of the storm, all tax deadlines for people in those areas were extended to January 3rd, 2022. So 2020 tax returns will still be going on into almost the beginning of the next tax season. So we can begin our webinar for this evening. And the first thing we want to do is define consumer credit. The word credit has many meanings. In the world of finance, credit is defined as an arrangement to receive cash, goods or services now and pay for them in the future. Consumer credit refers to the use of credit for personal needs. This is a definition from our textbook, Focus on Personal Finance, author Kapoor, the 6th edition. Consumer credit does not include home mortgage loans or loans for business purposes. That's a separate category of credit. The types of consumer credit. Consumer credit includes credit cards and personal loans. Credit cards may be issued by banks or merchandisers, such as department stores or other retailers. Personal loans are most often obtained from banks and may or may not be held against other accounts at the bank. Secured versus unsecured. What that means is a secured loan would be a card issued to you or a loan issued to you that you have to keep the same amount of money in your bank account to secure that loan. So if you had a $300 credit card, you would have to keep $300 in a savings account and not touch it in order to keep the card valid. An unsecured card or credit line would be you just obtain that based on your own personal information and credit, and it's not secured by keeping any amount of money in the bank. Lines of credit from checking accounts are also included in consumer credit. There's two types of consumer credit. It can be closed-end or open-end. Closed-end credit runs for a specific time frame and then is paid off, and is usually for the purpose of a purchase of a specific item, such as an auto loan or an installment loan for furniture. Open-end credit, on the other hand, is a line of credit available for multiple purchases at various types of places up to one's credit limit. So that could be for any type of merchandise or service that you want to buy. Whereas in an auto loan, obviously, the loan would just be for the car, and it would be for the amount of time that the loan is set up for, whether it be 7 years, 6 years. Auto loans are becoming greater in length as time goes by. Typically, auto loans in the past were only 5 years, but now they can go up to 7 years. All types of consumer credit involve the payment of interest. Interest is sometimes the factor in credit that consumers think the least about, but it is the factor that can make the use of credit very costly if not understood properly and used carefully. Interest is defined as a periodic charge for the use of credit. This is also from the Kapoor textbook, 6th edition. This simple definition belies the complex problems that high interest can cause. Most credit cards do not charge interest if the total balance on a card is paid within 30 days. For example, if one makes a purchase for $25 on July 4th and then receives a bill that is due August 1st, and then pays the entire $25 before August 1st, there will be no interest charge, and the card balance will return to zero. Interest charges on statements are often referred to as finance charges. Most people who have credit cards tend to carry balances on them. This is a typical situation and will not cause a consumer problems unless payments are made late or card balances outstanding are too high. However, in actually looking at a monthly statement, a consumer may realize the card may not be the great deal it seems to be. Now, this slide is a typical billing statement. This is from a statement from Kohl's department store showing balances, purchases, and there's all kinds of information on this statement. So we're going to take a closer look at this statement to see what does this actually mean. the information on this statement. The typical billing statement on the previous page contains a lot of information. When one opens up a billing statement, usually one will look at the current amount due that must be paid, the date that it is due, and maybe not much else. But it is interesting to see where the numbers on this statement come from and what they mean to the consumer. This sample statement is from Kohl's department store. As we had discussed in last month's webinar, department store cards are fairly easy to qualify for and are a good start in early credit building. However, some pitfalls can be seen right on this statement, including a high interest rate, in this case, 25.99%, possible late charges on which interest may accrue if balances are continued, and a statement about minimum payment warning. The high interest rate of 25.99% is typical of store cards and has nothing to do with the consumer's credit score. With this type of card, there is no preferential rate. The same high interest is applicable to all card holders, no matter what their credit rating is. This rate applies to the outstanding balance on a monthly basis. On this statement, we see that the monthly interest, the finance charge, was $37.12. The minimum payment due is seen to be $54. In this case, the minimum payment of $54 would cover the $37.12 interest charge, leaving only $16.88 to be applied toward the total outstanding balance of $1,880.97. Additionally, if the payment was made even 1 day late, after November 4th in the case of this statement, a $38 late fee would apply, causing the outstanding balance to increase instead of decrease, even though no new purchases were made and a monthly payment was made. And in this case, you have to be very careful with these payments too, because they can really catch you if you pay online or over the phone. It may not even be the date on the bill. You have to do it by a certain time, because it seems like with this bill in particular, it has to be paid before 7 p.m. on the due date. So if you think, okay, it's still November 4th, it's going to be, 11:45 at night, you can make a payment on the phone, that's going to be considered late and you would get hit with a late charge. So there's a lot of things that have to be looked at when paying these bills. I mean, certainly it's not good to wait till the very last minute to make the payment. But if you make it after a certain time, even if it's on that date, it can be considered late. Many consumers may find statements difficult to read or confusing. The sample that we have seems to have a lot of information on it. It looks like a lot to read. But much of the information contained on the statement has been required over the years to increase consumer protection and for consumers to better understand the financial implication of the cards. The sample statement includes two important warnings: a warning about the late payment charge and a warning about the minimum payment. The warning about the minimum payment is an eye-opener. If one made only the minimum payment on this card, it would take 10 years to pay in full. Additionally, the consumer would be paying $4,156 for items that were originally purchased for less than the $1,880 balance that's due. That is more than double the purchase price of the items. The minimum payment warning also shows that if a $70 payment was made instead of the minimum $54 payment, the time frame for full payment would be reduced to 3 years instead of 10 years. The total balance paid would then be $2,524. Even this is significantly higher than the initial purchase price and would eliminate the benefit of any sale price or discount the consumer may have received at purchase. So, when you go into a place like Kohl's or a department store, a lot of times they seem like they have very, very good deals, which they do at the outset. But then if you put it on their card and you get hit with all these interest charges, and if you don't pay the balance in full or let the balance accumulate, then the deals are not so great. Credit cards of all types, whether from department stores or banks, allow consumers to make purchases and do things they may not have been able to do with cash on hand. This is one of the reasons that credit is an important part of the economy, as it significantly extends the capability of consumers to purchase goods and services. One of the biggest drawbacks of credit cards is that many times consumers can get in beyond their means, particularly as the average person has more than one card available for use. If one's financial circumstances change, or if employment is lost, it may be difficult to make the credit card payments. This will cause financial stress and possible damage to credit scores. Now, one thing that these card companies issue that they try to sell to people is insurance on the card, so that if you do lose employment or your income is reduced, you can have this insurance that will make the payments for you probably for a period of 6 months. But the way that the insurance fee is structured is that's also part of the monthly payment, and then interest is accruing on that. And when you figure it out, it's probably not worth it, even though it may help you in times of financial downturns. But in general, I would say that it's just another way for the cards to make money. So that's something to think about, because when you get a credit card, they always try to sell you an insurance in case you can't make the payments. In the final analysis, there is no answer as to whether consumer credit is good or bad for financial freedom. Certainly, the use of credit gives one the opportunity to make better purchases or have a higher standard of living. But in the end, one must be capable of handling the payments and keeping the balances in line. Thank you for attending. Next month, we will address a related topic, credit scores, mysterious but important. It seems like everyone is always wondering how their credit score is figured out and what goes into it. It's a fairly complex issue. So next month, we'll be having the webinar to learn more about that. Thank you very much.
Thank you so much, Kathy. As always, it's super interesting to learn about these little tips or secrets, and sometimes they're not even secrets, and we all know them, but we forget, and then we get very easily in trouble. Thank you so much for reminding us and for teaching us new things. We always appreciate it. Here, there are some resources, but in the meantime, you can feel free to take a picture. We will send these resources to everyone that has attended in a follow-up email, so you don't have to go to them now, but feel free to take a picture if you're curious to see them soon. And again, if you'd like to ask any questions, please feel free to put them in the chat. Kathy, take advantage of her knowledge. She's here to answer your questions. And Kathy, I don't want to get ahead of myself. I know we're talking about credit scores, but I was just so curious. I know I should know this probably, but if I have this question of if you pay the minimum every month, as long as you pay it on time, it doesn't matter how long you drag your debt, or does that affect your credit score? And feel free to tell me, I'll answer that question next month.
No, but you're right. No, I do know the answer to that right now. Some of them I'm going to have to research, I'm sure, for next month. But that particular question, if you just pay the minimum payment each month, as long as you pay it on time, it certainly does not negatively impact your credit score. It's just that your balance will stay high. And one of the things we're going to talk about next month about the credit score is that there's uh, a debt ratio that is considered in determining your score. So if you can pay down the balances to below a certain percent of the credit limit, then that helps to increase your credit score. But as long as the minimum payment is made every month, and the balance will stay high, but it won't make your score go down. It's just it won't help your score to go up.
Right. Okay. Thank you. Thank you. And then like what also caught my attention was like the sale, like in a department store, you think that you're getting this great deal. And then all of a sudden, like you have all these fees and, the interest that you have to pay. And I never actually like thought about it that way. I was like, well, it's a good deal. Let's put it in the credit card. I'll deal with it later. And I'm sure it happens a lot. And do you, like, I always think about like, how do people learn about this if they are not, coming to a workshop, or like, are young people learning about this? And do you have any advice for young people that are just becoming independent, financially independent? Where do they, I know we have resources here that we're sharing with people and this will help. But if they want to be paying attention to this, what do they do?
Well, that's actually a very good question, Cecilia, because actually when I was writing this webinar, of course I knew this stuff like in the background, like in my subconscious, I kind of knew, okay, high interest rate is going to create, very high balance and, make you pay more than you would have. But to actually do the math on this, to see that if you took 10 years to pay the balance, that the items would actually cost you over double what you paid for them, it's just not something that anyone really thinks about. And especially younger people, of course, it's very exciting to get a credit card and to go and spend money and, have things. But it's like younger people should try to like listen to workshops and maybe read, or I know that younger people are not really inclined to read things from a book, as we might, but there's things like online and I believe on social media that probably would help them learn this information, like the background of what is underneath
And
getting
it's always good to be on top of it, right? Like
yeah,
if
yeah,
you're like, it's
because
very easy to like lose control, and you'll
mm-hmm.
say, okay, next month, but next month something comes up. And then the other question is like, what would you advise someone who is in that situation, who already got themselves into a debt and find themselves paying all these interests and late fees? Where do you start to fix it?
Well, I would say definitely, just as you were saying before, to just try to make the minimum payment. That's an absolute must, and to try to pay it by the due date. So, because the late charges really could possibly even increase the balance. So, to pay it late is not going to be helpful, and then that could impact your credit score. See, like with this particular department store card, when it's late, like when it's paid like even an hour late or a day late, that's not reported to a credit bureau. It would have to be like 30 days late, like literally, for it to be reported anywhere. But the point is, it's still not helping the balance to go down. So anyone that gets himself into a problem, hopefully they would be able to make a few payments and catch it up, at least to get back to paying the minimum.
Right.
And obviously the best thing would be to try to pay off the balance every month, but
Without getting
a lot
into
of times that's
farther
impossible.
and right,
Yeah,
without like getting into farther and deeper,
right,
trouble.
right. And the whole idea of, why people want to use credit cards is because they don't have the cash on hand, or they don't want to use the cash. So it's like paying the balance in full is almost like, oh, okay, I paid cash. So that's not, in a person, typical person's mind, that's not really, helping out either. But that's really what should be done. In a best case scenario, the credit should be used and then the balance paid each month.
Right. Good advice. Thank you so much, Kathy. I mean, this is all super helpful. Again, it's like even if we know it, it's very good to be reminded of how to keep the control over, our finances. And actually, like the name of our series, like be financially, literate and independent.
Right. And a lot of it is just reading, because even in the example that I used, I mean, just reading that statement tells you an awful lot of information that is not good.
Right.
So
right.
it's not going to make people feel very happy, but it's the facts. It's just the facts. So, and when you're out having, a nice time or buying something nice, you're not thinking about all these, financial implications in the background.
Absolutely. Absolutely. Well, it's been a pleasure. Again, like we have a couple more minutes while I share some of our events. If you're an attendee, feel free to post more questions in the chat. I wanted to share with everyone that we had an amazing event last Saturday. We had a walk. I wish I put a picture of the event in the PowerPoint. We had a lovely day. We had about 40 attendees. And it was beautiful. We were able to connect with friends. It was our first event in person at our location for Taunton after our grand opening right before COVID happened. And the event continues virtually until next Saturday. The next Sunday on the 24th. And Lana, if you don't mind, put in the chat the link to our walk. Please do so. It's like you can still buy tickets, you can still donate. So we always support. We always appreciate your support. And then also, if you're not a member already, we'd love to have you at the center. Here's the website, and Lana, I think she already shared the membership link, and you can also donate. Let me see, there's something in the chat. Yeah, I'm gonna put that in the chat. And finally, feel free to contact us to ask any questions, to become a volunteer. Here, feel free to take a picture to our contact information. We have 2 locations, one in Queensboro Hall and one in Bayside at Fort Taunton that is finally open, and we're excited. We'll have many in-person programs starting in the spring. We're also on social media. Follow us on Facebook, Twitter, Instagram, YouTube, and we also have a podcast that just started. Thank you all so much for coming, and have a great evening. And we hope to see you next month to talk about credit scores. Thank you, Kathy.
You're welcome.
Have a good night, everyone.
Thank you. Good night, Cecilia. Thank you.